Welcome to Iron Financial. This is the one place where we help you forge a stronger portfolio because we stress test company fundamentals and we cut right through all the market weakness. Now look, in a market that is just obsessed with tech, AI, and all the hype, we are going old school today. We are diving deep into the very heart of the industrial economy with Steel Dynamics, ticker STLD. They just dropped their full year 25 earnings report, and honestly, the headlines are telling two completely different, contradictory stories. So it is our job to figure out which one is the real deal. Let's get to work.
Okay, let's frame this whole thing up. On one side, you have the company blasting out press releases, and they're celebrating something huge, record steel shipments. I mean, they've never moved more product in their history. Now that sounds like a company that is just firing on all cylinders, right? An absolute industrial powerhouse at the very top of its game. But then, you look at the other side of the ledger, the bottom line, the actual profit numbers, and what you see is a structure under some serious strain. You've got record volume, but profits are shrinking. And to me, that is a massive, massive red flag.
And that's the whole ballgame right there, isn't it? I mean, anybody can sell a dollar for 90 cents. Moving a ton of steel is great, but if you aren't actually making more money doing it, then what's the point? It really smells like they're just running on a hamster wheel, burning a tremendous amount of energy, but ultimately just going nowhere. We absolutely have to know if the foundation here is solid or if this is all just a well-polished facade.
Exactly. And to figure that out, we have to start with the story that the company wants us to hear. This is their bull case. This is the highlight reel that they are presenting to Wall Street and to every investor out there. They are trying to paint a picture of a perfectly oiled machine, something that's just churning out cash and rewarding shareholders left and right. So let's see if the materials they're using to build this story can actually hold up under some real scrutiny. Now, if you just look at these numbers in a vacuum, they are undeniably impressive. I mean, you can't ignore 13.7 million tons of steel shipped. That is a record for a reason, and it signals that the demand for their product is incredibly strong. $18.2 billion in net sales, that is a massive top-line number. And they're not just selling things, they're generating serious cash, $1.4 billion from operations alone. Plus, they're sitting on what is essentially a mountain of cash and available credit. We're talking over $2.2 billion in liquidity. And as if that's not enough, they went out and bought back nearly $1 billion of their own stock. These are not the numbers of a company that's struggling. Operationally, they look like an absolute titan. And here you have the narrative summed up perfectly. This comes straight from the chairman and CEO, Mark Millett. He's using words like solid performance, strength, consistency. He is pointing directly to that massive cash flow number as the ultimate proof that the business model is working, that it is resilient. The message they're sending couldn't be clearer. We are a fortress. We are unshakable.
A fortress? Okay, hold on, pump the brakes. That's a great story, and you know what? The CEO is paid very well to tell it. But a fortress can look completely impenetrable from a distance, while on the inside, the walls are actually crumbling. Those big, flashy, impressive numbers you just listed, they're doing a really good job of hiding a very serious problem. It's a structural issue. It's a crack in the foundation that you just can't see unless you're willing to look past the headlines and really dig into the profit engine of this company. So let's put this so-called fortress under a real siege test.
And here it is. This is the number that completely undermines that entire bull case, operating income. This is the pure, unadulterated profitability of the business before you get into any financial engineering or accounting tricks. So in 2024, they generated $1.9 billion. Okay, great. A year later, in 2025, after shipping all of that record volume of steel, their operating income plummeted to $1.5 billion. So let me get this straight. They worked harder, they shipped more product than ever before, and they made $400 million less for all that effort? That is not just a red flag, that is a 5-alarm fire raging inside the fortress wall.
Let's just put an even finer point on it. A 24% drop, a full quarter of their core profitability just vanished into thin air in 12 months. So I'll ask you directly, as the analyst, how does a company that is seeing record-breaking demand and shipping record amounts of product see its profits collapse by 24%? That is not a small crack in the armor. That's a massive fault line running right through the middle of their entire story. Explain that to me.
That is absolutely the right question to be asking. And you're right, that 24% drop is the central conflict here. It's where the bull case of operational strength runs head-on into the bear case of collapsing profitability. The only way we can settle this is to stop looking at the high-level consolidated numbers and really break this company down to its core components. We have to go segment by segment, beam by beam, and see what's holding the weight and, more importantly, what's about to buckle. It's time to get our hands dirty and actually forge through these numbers.
All right, let's start with the heart of the company. This is its main load-bearing wall, the steel operations. This segment is the biggest and by far the most important part of their business. If there's a problem here, the entire structure is at risk. So we need to see if this core is still strong enough to carry the entire load, or if it's starting to show signs of buckling under all of this pressure.
So when you look at this table, the most crucial thing that jumps out is the sheer volatility. Just look at that operating income column. It is an absolute roller coaster. They started 2024 incredibly strong, pulling in almost $675 million of profit in a single quarter. But then it just fell off a cliff. Look at the drop from Q1 of 2024 all the way down to Q4, where it bottomed out at just $165 million. That's a 75% plunge in quarterly profit in less than a year. Now, if you look at 2025, yes, there's a recovery happening through the year, and that's exactly what the bulls will point to. Sales are climbing back, operating income hits nearly $500 million in Q3. But, and this is a very big but, that is still nowhere near the peak profitability they saw just a year and a half earlier. The trend might be heading up, but it really looks like the ceiling is getting lower.
You know what? Let's make this even simpler. Let's just cut through all the noise. This chart puts it in stark, unavoidable relief. Forget about the sequential quarter-over-quarter recovery for just a second, and just look at the direct year-over-year comparison. In the first quarter of 2024, they made $675 million. 1 year later, in the first quarter of 2025, they made just $230 million. That is a collapse. It's like a heavyweight boxer who's still on his feet, but he has taken an absolute beating and his punches just don't have the same power anymore. Yeah, they might be shipping more tons, but each and every one of those tons is dramatically less profitable than it was before. This isn't just a cyclical dip. This is severe, painful margin compression.
And you've hit on the exact mechanism here. To really understand the profitability of a steel company like Steel Dynamics, you have to understand a concept called the metal spread. Think of it like the gross profit for a bakery. It's the difference between the price of the cake and the costs of the flour and sugar. In this case, it's the difference between what they sell a ton of finished steel for and what it costs them to buy their main raw material, which is scrap metal or ferrous scrap. This spread is their gross profit per ton, and frankly, it is everything. As you can see right here, in the third quarter of 2025, they were selling steel for an average price of $1,119 per ton, while their key input cost was $381 per ton.
Okay, now let's use that to build the case for why profits are collapsing. Compare that last slide to this one, which is Q1 of 2024, their peak profit quarter. Back then, they were selling steel for over $1,200 a ton. Now yes, their scrap cost was a bit higher at $417, but look at the difference. The price they could get for their finished product has fallen by almost $100 a ton, while their input costs have only fallen by about $36. That $84 difference in selling price came almost directly out of their profit margin. That spread got squeezed, and when it did, it squeezed billions of dollars in potential profit right out of the company. That right there is the entire story behind that 24% drop in income we were talking about.
Okay, so it's crystal clear now. The core steel business is under significant pressure from shrinking margins. That's a fact. So the next logical question is, can the other parts of the company pick up the slack? We need to look at the supporting structures, their steel fabrication business, their metals recycling, and their brand new aluminum business, to see if they're providing some much-needed stability or if they're just adding more strain to an already stressed system.
Let's start with steel fabrication. For a while, this was an incredible profit center for them. I mean, look at the first half of 2024. They were consistently pulling in $170 to $180 million in operating income every single quarter. That's fantastic. But just like the main steel segment, that profitability has eroded significantly. By the middle of 2025, that income has been nearly cut in half, down to around $93 million in Q2. So this segment isn't riding to the rescue. It's actually another victim of the same cyclical pressures, and it's a major contributor to the overall profit decline.
And then you've got metals recycling. Look, this business is steady, I'll give it that, but let's be realistic about its actual impact. It's a very low-margin operation. In their absolute best quarter here, they made about $31 million. In a period where the main steel division's profit is dropping by hundreds and hundreds of millions of dollars, this segment is like a rowboat trying to stop a tidal wave. It's a necessary part of their vertically integrated model, I get it. It feeds the beast. But it is not a profit driver. It is not going to rescue the bottom line. It's just a cog in the machine, not an engine.
Which brings us to their big, new strategic bet, the aluminum segment.
This is supposed to be their future growth engine. It is a multi-billion-dollar investment specifically designed to diversify the company away from just steel and to capture completely new markets. And as you can see, they're starting to generate some sales, about $71 million in the most recent quarter. But what's absolutely critical to focus on here is the operating loss. This is a business in pure startup mode, and startups burn cash.
Burn cash is the understatement of the year. Look at the trend in that loss column. It's not shrinking as they get more efficient, it's accelerating. A $29 million loss in Q1, then a $41 million loss in Q2, and now a $57 million loss in Q3. They are losing more money every single quarter as they try to ramp this thing up. This is not a supporting structure. This is a financial black hole that is actively draining resources from the rest of the company.
Let's just put a bow on it for the full year of 2025. This brand new, high-stakes venture posted an operating loss of $155 million. So while their core steel and fabrication profits are falling off a cliff, they are simultaneously lighting a pile of cash the size of a small car on fire every single quarter just to get this new project off the ground. Now, the bulls will call this a strategic investment. I call it a massive cash burn happening at the absolute worst possible time. This isn't helping. It's making a very tough situation that much worse.
Okay, that is a very fair point. The cyclical businesses are clearly in a downturn, and the new growth business is a drag on current earnings. There's no debate there. But this is exactly where we separate the real contenders from the pretenders. The true test of a company in a cyclical industry isn't just its income statement during a tough period, it's the strength of its balance sheet. A company's financial foundation is what determines whether it can survive the storm and emerge even stronger on the other side. So, let's put their balance sheet to the ultimate stress test.
This slide right here shows the bedrock of the company. They have total assets of over $16 billion. And yes, they have long-term debt of about $4.8 billion, which is a significant number. You can't ignore it. But look at the total equity line, nearly $8.8 billion. That is a very, very solid equity base. It gives them a powerful foundation. They have far more equity than long-term debt, which is a textbook sign of a conservatively managed and incredibly resilient financial structure. It means they can withstand a whole lot of pain before they ever get into trouble with their lenders. This is their financial cushion. And this number is what gives management the ultimate flexibility. At the end of the year, they had $2.2 billion in total available liquidity. Now that includes their cash on hand, plus all the money they can draw from their credit facilities if they need it. This is their war chest. This is the financial oxygen that allows them to fund the aluminum plant's losses, to weather any further downturn in steel prices, and to continue investing in their business without even breaking a sweat. This level of liquidity is a massive strategic advantage. It's the difference between being a victim of the business cycle and being a master of it.
And if you want the absolute strongest signal of what management really thinks about the future of their company, you have to look at this slide. In a year where their operating income fell 24%, they turned around and returned $1.2 billion to shareholders. They spent over $900 million buying back their own stock. You just don't do that if you think your company is in serious trouble. You do that when you believe your stock is fundamentally undervalued and you have supreme confidence in the long-term cash-generating power of your assets. This isn't an act of fear. This is aggressive, unapologetic confidence being broadcast to the entire market.
Is it confidence or is it hubris? They're returning massive amounts of cash to shareholders while their profits are falling and a brand new venture is bleeding money. It's a bold move, I'll give them that. So, we've looked at the bull case, we've exposed the cracks, we've analyzed the core and all the supporting structures, and we put the foundation through a stress test. I think it's time to put it all together and render the official iron financial verdict. Is this a company built to last, or is it a house of cards just waiting for a strong wind to blow it all over?
So here's the final tally. The strengths are absolutely undeniable. This is a best-in-class operator that is moving a record amount of product. It is a cash flow machine with a fortress balance sheet, and its management team is signaling extreme confidence through those massive buybacks. This is the structural bull case. But the weaknesses are just as stark, and you can't ignore them. The profitability of their core business has been severely damaged by that margin compression we talked about. Their big, expensive bet on aluminum is, for now at least, a financial black hole. And all of this is happening within a very tough, very unforgiving, cyclical industry that can chew up and spit out even the strongest companies. This is the cyclical bear case. What you have is a great company that is facing a terrible environment.
And that leaves us with the ultimate question for any investor who's looking at this company right now. Are you looking at a structural bargain? Is this a best-in-class operator whose long-term strength is being temporarily masked and therefore deeply undervalued by these short-term cyclical headwinds? Or are you looking at a cyclical trap? A company's record shipments are just hiding deteriorating fundamentals, where the shrinking margins and the massive cash burn from the aluminum plant are actually warning signs of a much tougher road ahead. The numbers are all here, the story is clear, the decision is yours. Thanks for joining us on Iron Financial, where we don't just follow the market, we forge our own path.